Good morning, everybody. Ati here. I'm going to switch off my camera again. Can we just get a thumbs up from one or two of you to confirm that you can hear me well enough? Thank you, Claire. Right. Good morning. Welcome to this another edition of our free webinars or training sessions by Linc. My name is Ati Retief. Some of you may know me. And today we'll be talking very broadly about inventory costing and some other inventory related, specifically costing related topics for Business Central. Just to introduce myself, I'll be the presenter and Marco will be our moderator, just to make sure I don't miss any questions, etc. You are all muted, and if you have questions, please post them to the Q&A section of the Teams meeting, and we will address those later on. I see Claire, is your hand is still up. Anything you want to ask now? Is there something? Okay, you dropped your hand. Thank you. All right. So the agenda for today, which we also had in the invite, is as follows. First, we're going to be touching briefly on some of the concepts behind inventory costing in Business Central. These are not all of the concepts, but these are the important ones. So these will be the different inventory costing methods available in Business Central, the concept of inventory periods and how those can be used and what the implications are, the concepts of posting setup and posting flows for the integration between inventory and the general ledger, and the concept of item application. Then we'll look at some tasks or actions that you typically would need to know about in Business Central, such as the revaluation of inventory, application worksheets. We'll talk about valuation reports, and we'll talk about the act of adjusting costs. And then finally, we'll touch on the integration to the general ledger, specifically just look at the difference between batch posting and real-time posting of the integration to the general ledger. All right, so to kick things off, we'll start by looking at the inventory costing methods. Now, I'm going to just skip ahead here to this slide. I will be sending out these links to all of the attendees that are in this webinar this morning after the webinar, or Monday or so. And what this is that for all these actions and concepts, I've isolated the relevant articles on the Microsoft Learning portal where you can find all the documentation for Business Central. And each of these, in a much more deep sense, describe the concepts and the actions that we're going to be touching on today. Now, just to be clear, we could probably spend an hour on any one of these topics from a training or a webinar perspective. So today is very much an introduction to these concepts and an introduction to these actions to give you a very broad overview of the important things that you need to know about to fully understand and get the best value out of the inventory and inventory costing functionalities in Business Central. If you want to dive deeper into any one of these concepts, I encourage you to have a look at these articles. And then also, if after today you've read through some of these articles, I'll invite you to send me an email to vote for or ask for a specific session on any one of these topics that you feel would help you or would be worthwhile. And then I'll compile these requests, and then we'll consider scheduling a session on specific topics here, one or two, or however many people seem to want to know more about. Okay. So I'm actually going to discuss these topics by actually referring to those different articles and showing you some of those articles on the screen. And we'll start with the inventory costing methods. So if we look at the articles that I've mentioned, here's the design details of costing methods in Business Central. It's an article on the learning portal, and I've given you the URL. Right. So what is a costing method? Costing method here refers to the decision you make on item cards or item masters in Business Central as to how you want to value the inventory related to that item. And the different options within Business Central are these: FIFO, LIFO, average, specific, and standard. So I'll just briefly touch on what these are. Again, we can't go into the kind of detail that this article goes into to explain what the different methods do. And you'll see there's tables here that give you an example of how the inventory will be valued under each one of those situations. I really encourage you to read this article. As I said, I'll send you the links. But the basics are as follows. Standard is pretty straightforward. This is where you decide manually what you want to value an inventory item at, and the standard cost is either arbitrarily chosen to reflect something of the current market value of the item, or in a manufacturing environment, the standard cost is typically the rolled up cost of the components of the bill of material that make up that item. It's mostly still used nowadays by manufacturing companies. Very few companies that do just purchasing or other forms of trading still use standard costing, but it is still supported and used in Business Central. Specific costing is where you want to apply very specific costing to items based on the fact that they are procured and tracked at either a serial number basis or a lot number basis. In other words, you're saying, I have an item master for a certain product that we buy, but when we buy it in specific lots. We enable lot tracking for it. And what that then, if you choose specific costing for such items, then each lot will have its cost of positive adjustments, such as purchases. That cost will specifically be applied to the sales that are generated, or the negative adjustments or movements that are generated for those items. In other words, it very specifically ties the the positive and the negative cost movements of the item against each other. The other methods which are more typically used are the average costing method and the FIFO costing method. LIFO is sometimes used. We don't see it very often. In fact, Microsoft makes a point here that some countries don't even allow LIFO, or based on the fact that it can depress profits. But the most typically ones used across our client base, at least, is the average cost of the FIFO cost. And the main difference between average and FIFO is just again the principle of how Business Central decides what to value certain negative movements at, such as when you make a sale, what determines the cost of sale of that specific sale is greatly influenced by the costing method that you choose for the item, being average or FIFO. Average simply means that all of the items' inventory is valued at the same value, and there are different ways in which you can configure the system to choose whether that average cost is averaged over a day period or a week period or a month period. Whereas FIFO is a bit more specific in that the system assumes that the items bought first will be depleted first, and so negative movements are applied to the oldest positive available movements first, and the costing of those negative movements also follow that logic. Again, this is just an introduction. Please have a deeper look at the article. In terms of just showing you some of the evidence of this in the system, if we look at item masters here in Business Central, you might already know this. Any item master has on its costing tab the chosen costing method. These are the methods we just discussed. And depending on what your costing method is, you'll see that Business Central maintains this unit cost, which is actually a calculated unit cost for the item. And if it's a calculated unit cost and you drill into that unit cost, then Business Central will summarize the different increases and decreases during your costing period for the item and give you a sense of how that cost moved up and down. Now, what do I mean by the different costing periods? For FIFO, it's very specific dates, but if you use average cost, then Business Central has a concept in the inventory setup, which I want to show you now. And this concept is to decide two things. One, for average cost, on what basis must it average the cost of an item? In other words, is the average cost of an item based on purely the item level? In other words, no matter where you transact with that item from a location perspective or from a variant perspective, all of the inventory for that item code is considered similar, and so the average cost is averaged across all of the entries and all of the available inventory for that item. Versus if you choose item location and variant, it will maintain a unique average cost for the different permutations of item location and variant that you might have in the system. So for a company that wants to use average cost but have distinct locations with distinct inventory movement patterns, it might be useful to choose this option, because then one location or one branch is not effectively penalized or affected by the inventory movement from a value perspective by another branch, which might have a completely different circumstance in terms of how they deal with inventory. So that's what this calculation type is for. And then the average cost period, you can see there the tooltip there, it specifies the period of time used to calculate the weighted average cost of items. So this just means that the average cost of the item is unique on a per day basis. In other words, all the positive and negative movements of a specific date will form a pool across which the average cost is calculated. Whereas if you choose week, everything that happens within the same week will effectively have the same average cost. If you choose month, then everything that happens within a certain month for the item will have the same average cost. So this is just the average cost period over which the averaging happens for each item. If you choose a counting period, then the date across which the weighted average cost is calculated will follow your accounting periods as defined in your general ledger setup. If they are different from calendar months, then that would be useful. Last point to make about the costing methods is just that you can set up what your default costing method is, so that when new items are created, then you can have them automatically set to this value. All right. So that's the concept of inventory costing methods. I really encourage you to have a look at that article. The next concept is the concept of inventory periods. What are they and why are they useful? Okay, so inventory periods, if we go to Business Central here, you'll see that there is a setup area for inventory periods. And here you can create inventory periods that end on certain dates. You give it a name and you can indicate and see whether the inventory period is closed or not. All right, so again, if we look at the articles here, of which I will, as I said, send you the URLs, There's a whole article on inventory periods. What are they used for, etc. How do you close them? How do you open them? What do they do? So to understand what the use of an inventory period is, it's also worth just reminding everybody, if you don't already know, about the accounting periods in Business Central and the allow posting to and from functionality in Business Central. All right, so you can have financial accounting periods in Business Central that are defined months of financial months within your accounting system. And the idea is that at some point in any ERP system, when you are ready to do management accounts and other forms of reporting, you want to ensure that the numbers that you have reported on don't move, don't change after the month has been closed. And so we know that we have the ability in Business Central to close accounting periods, which will prevent further posting of financial entries into that period. Now, similarly, for Business Central, it is useful, if you so choose to use it, to also have such closing capability for specifically the inventory financial entries that go to your general ledger related to inventory. So what this means is that if you have inventory periods created and you close them, then any inventory movement that might have a costing effect and a corresponding inventory valuation effect on your trial balance somewhere, if the date applicable to that particular inventory costing entry is before or on the ending date of a closed inventory period, it will not post that inventory cost effect into your general ledger with that posting date. It will post that movement, that value movement in your general ledger. It will post that to the first available posting date after the ending date of the inventory period. It just gives particularly cost accountants much more control over having reconciled and closed a particular period for inventory valuation purposes. It's really as simple as that. To understand how that works in a bit more detail, again, I will encourage you to have a look at the inventory period article that I'll be sending you. All right, the next topic, which we'll spend a few minutes on, is posting setup or flows. This is to explain how do we set up where inventory from a value perspective posts to on the general ledger, whether it be balance sheet or income statement. And I hope to not dazzle you too much with this next slide, but it is a good slide to try and explain what's going on. Before you run away, please just calm down. We're not going to discuss all these arrows. But it is a very good picture to explain how the different posting setups in Business Central control how different subledgers in Business Central flow to your income statement and balance sheet. And we're particularly, for this discussion, going to focus purely on this inventory orange block here and some of the general posting setup here. The rest we're not going to touch on now. These all have to do with, vendor and customer subledgers and how journals find their way into the different posting areas of BC. We're going to focus on inventory and we're going to focus on the general posting setup. All right. Now, before I explain more of the slide, I want to just quickly show you where the inventory posting setup lives in Business Central and where the general posting setup lives. Let's start with that first. So I'm going to be switching to my Business Central again. So the first thing I want to see is inventory posting setup. Here this is, and here you can see this is a posting setup screen where I can specify which inventory account to use for combinations of location codes and inventory posting setup codes. All right. So location codes, you can understand. These are the different locations or branches or warehouses that you might have in your business. And the inventory posting group codes, these are typically set up and then mapped to individual items. So if we look at an item, any item for that matter, let's look at this Paris chair again. On its cost and posting card, you'll see that the inventory posting group that this item falls into is the resale group. That's one of the two options we saw on this previous screen. So what this means is that if I post inventory movements for this item, and those inventory movements must have an effect on the stock control account or inventory control account on the balance sheet, then Business Central will come to this particular posting setup table to see what, for that item is the movement you posted in, which warehouse is it, which location was involved, and once it finds the location, then it looks for the resale group because that's what the item is in. And let's say it was the main location, then this row will be used to figure out which account to post to. And what I mean here by which account is which balance sheet account represents the control account, the inventory control account, or the stock control account that holds the value of this item. Now you'll see that there's two accounts here, the inventory account and the inventory account interim. We'll explain the interim version of the account in a minute, but suffice to say that the inventory account is the one that holds the actual cost of an item. And if you use expected cost as an option within Business Central, it's the expected costs that will post to this inventory account here. Some companies prefer to separate those into two different balance sheet accounts, just closely next to each other, and the sum of the two accounts should reconcile to the sum of actual and expected costs for your items or for specific item groups. All right, we're not going to be discussing the work in progress and other variance accounts for manufacturing today. As I said in the invitation, if we won't have time to also talk about manufacturing costing, we will have a future session on that, and then we'll go into all of these accounts more deeply. All right. So this is the balance sheet integration for your inventory items. And just back at our picture, you can see here, that's what's controlled by the inventory posting setup here, right? So you'll see the arrow here, this one that scrolls all the way down to here. It mainly controls how the inventory values flow to and from the inventory and interim inventory accounts, those two there, which typically are under current assets in your balance sheet. And the next posting setup to talk about is this general posting setup. And again, for inventory items, this controls typically income statement type of postings for inventory. What specifically? These would be cost of goods sold, it would be direct cost applied, it would be inventory adjustments, etc. So it's those three or so accounts that are important to understand there. So where do we manage general posting setup? We do that here in Business Central General Posting Setup. All right, so how does this work? So every purchase type of transaction I do with inventory in the system involves two entities. It involves a vendor or a supplier or a creditor, and it involves an inventory item. Now, the vendor or the supplier or the creditor, that depends on what you want to name them, is grouped into one of these general business posting groups, which you can set up in the system. And then on your vendor cards, you will put a vendor into one of these groups. Your items are similarly grouped into one of these general product posting groups. So as we saw on the item card there that we showed earlier, items. We look at this this item here, you'll see that it has a general product posting group. Not the posting group, inventory posting group. This is the balance sheet grouping. This is the income statement grouping for posting of the inventory item. So here is where you choose which general product posting group this item belongs to. And then when I post a purchase transaction for that item, the system will find the appropriate row in this matrix for the vendor involved in the transaction and for the item involved in the transaction from the product posting group perspective. So let's say it was a domestic supplier from which you bought one of these items. Then you'll see there's lots of GL accounts specified for this particular setup, but the ones that are relevant to the inventory itself is this cost of goods sold account. So this is where your cost of sales will post to for an item. Well, and this is a bad example. I was talking about vendor, but the same is true for a customer. If I sell to a customer in one of these groups an item that falls into one of these groups, then the row will determine my cost of goods sold account. It will determine my cost of goods sold interim. This is when you don't have a final cost for the item yet. And it will also determine, those are the two main ones for sales. If I'm purchasing from a vendor in this group and the item is in this, then the GL accounts typically used are the direct cost applied account and the purchaser's account. And when I post a stock journal, such as a negative or a positive adjustment for adjusting stock up and down, where there isn't a customer or a vendor involved, then the general business posting group is blank, but the product posting group is still the product posting group of the item. And so it would use these rows to then find the appropriate setup. And typically the account the system is interested there would be the inventory adjustment account and the inventory adjustment account for where to post the increase or decrease in inventory value to. This same account is also used to post any revaluation of inventory, to post that revaluation to the income statement. One last account to talk about is the inventory accrual account here, which is typically used in a purchase scenario where you have done a purchase receipt with an expected cost, but you don't have the purchase invoice yet. So this would be something like the goods received not invoiced account, typically a GR&I account. And then when you do invoice the purchase, then it will move the value out of the GR&I account and into your purchases accounts. Right, so this is really all that this picture tried to illustrate, and really that's what I wanted to try and cover under this posting setup and flows area. Okay. The next topic I want to touch on is item application. Just before I move on, the posting setup and flows article here is the article I will send to you, and it explains in some details how the different entries flow. Right, the next section is on item application, and the corresponding article is this one here. Now, what is item application? What's it all about? Well, in simple terms, what this is trying to explain is how does Business Central, and I mean, Business Central isn't unique in this, any system that wants to work with inventory value and inventory costing has to have a system to link, for want of a better word, to link negative movements of inventory to corresponding positive movements of inventory. In other words, if I sell 2 units of a particular item out of a certain location, Business Central needs to know where did you get those 2 items from? What was the positive movement that gave rise to the 2 units, and what was the cost of those positive movements depending on what costing method you chose, average or FIFO or whatever, because it needs to figure out when it creates the value entries for those 2 units of negative movement when you sell it, it needs to figure out what cost that movement needs to be at. In other words, what would the cost of goods sold be for that negative movement? And Business Central does that by keeping track of all the positive movements of inventory and the negative movements of inventory and linking them against each other in a very detailed way. That linking in Business Central is called item application. It's applying negative entries against corresponding positive entries. And that application is the foundation for what determines the cost of the negative movements. Again, it also incorporates the costing method you chose, but it does all of this by applying negative movements of inventory against positive movements of inventory. And even in a situation where you would temporarily allow inventory to go into a negative, in other words, some companies will say, listen, just the way we post things, we can sometimes process a sale of inventory, but we haven't necessarily processed the receipts of that inventory yet. Then in Business Central, you can tell Business Central to allow negative inventory, but that really is supposed to be a temporary situation, because at some point you have to balance the inventory back down to zero. So you're going to have to purchase that stock, or you're going to have to positively adjust it. Either way, the positive movement that must supply the inventory that you negatively moved has to eventually have a cost, and that cost will eventually determine the cost of sale of the negative movements. I hope that makes sense. I'll try and illustrate a little bit what I mean by looking at a particular item. Let's just try this one again. And let's say if we look at the inventory of this item, you'll see that the inventory of this item is the sum of all of the positive and negative movements of this item over time. This is typically called the item ledger entry table. So this is a detailed ledger of all the positive and negative movements of an item over time. Let me just see if this is sorted in a certain way, starting in 2020. So this item 8 were purchased, then 4 was sold, and another 4 was sold, then 10 was purchased, and another 5 was sold, another 5 was sold. So these are all the different movements. But as I said, each of these movements have some kind of relationship to each other. This is how Business Central keeps track of what your remaining quantities are per item ledger entry. And what are those? Those are called item application entries. So if I'm interested in seeing this particular sale here, what specific positive movement did this sale apply itself to that would have then determined the cost of that movement? If I highlight that entry and I click on entry applied entries, then it'll show me that that sale was applied against purchase document number 107021, and specifically, there'll be a specific item entry number behind this, and it applied for. But this is a simple example. You can just based on the flow of transactions, it's easy to see that these 2 sales depleted that 8 coming in there, and depending on the costing method of the item, then this 390 cost amount actual makes sense. Because it's clearly half of the cost of the positive movement that it applied against. But in a scenario where you have multiple locations or different variants of items, or even different, slightly different costing methods, such as average or specific, then it's not necessary that by simply reading the item ledger entries and their cost amounts that you can figure out why the system arrived at this particular cost of this sale or a negative movement simply by just looking at the screen. And then it's helpful to ask the system, what did you apply this sales entry to? And it may have even applied it against multiple entries, because at the time of making the sale, maybe this positive here had 1 unit left and that positive there had more units left. And so this sale might have been applied against 2 positive. It would then show you what those applications are and how the different positive entries contributed to supplying the inventory for the negative movement. And it will then tell you the story of the application, and in so doing will explain to you how it arrived at the particular cost for that negative movement. All right. So that is in concept the item application. Okay, so next I want to look at some specific tasks that are useful and that you might need to do from time to time, where the articles are that describe how that works, and generally just how the function works in Business Central. So the first topic to touch on is revaluation. And this is useful in different circumstances. Like I said, if you're a manufacturing company and you decide to use standard cost as your costing method, then you definitely need to revalue your inventory from time to time, particularly if there's huge fluctuations or increases in the cost of raw materials. Then from time to time you need to recalculate your standard costs in terms of rolling up the latest available costs of the input materials to your manufactured items. And when you do that new standard cost calculation, you typically want to revalue your inventory on hand to that new cost. But even in scenarios where you use FIFO or even average cost, there may be situations where you need to revalue the inventory on hand. And so the article that explains that is this revalue of inventory and how to do it. There's also a design details article that you will be able to link to understand what the concepts are behind inventory revaluation, etc. How we perform that within Business Central is by going to the revaluation journal, item revaluation journals. Just like other journals in the system, you can have different batches. This batch has got some stock on it already, but the main process is as follows. In order to revalue anything, any item in Business Central, you first have to start by calculating what the system believes the value of that inventory is at this stage. So this, if you run this is a batch job that you can run. You give it a certain date and a document number. You ask it to calculate the revaluation on a very granular basis by item ledger entry, or typically for average cost, you would choose to revalue the item in totality, and you can choose to do it by location or variant or any permutation of that. If you have this particularly standard cost, then you can choose to have a calculation for the new cost, but this is typically left blank. Then you can limit the number of the specific items you want to do it for by adding more filters to this area here. And then you run this job, and then it populates this journal with all the items that you chose to revalue with your chosen posting date and document number. It shows you what the quantity on hand is for that item, what the calculated unit cost is, and therefore what the calculated inventory value is at your revaluation date. And then this field here is where you can then manipulate the unit cost by either having it automatically filled in with a newly calculated standard cost in a manufacturing environment, or just simply typing in the new value that you want to apply, and it will then say what the revalued value will be. And I think you can even edit in Excel this particular sheet. So if you want to do calculations and populate this in Excel, then you can use the edit in Excel feature as well. This is in essence what you do. you can then run some reports or do some preview posting on it to see what the effect of it is, and then you can also run a test report, and then eventually you post this, and it will post all of the adjusting value entries to the inventory, and your inventory is revalued. So that's revaluation. The next thing I want to touch on is application worksheets. Now, like I said earlier, let's just remind ourselves. I said if you go into any particular item and you look at its item ledger entries, you can have a look at any negative movements such as these and ask the system, what were you applied against, right? And it'll tell you, I was applied against this purchase transaction, and particularly 5 units was applied. Now, Business Central allows you and gives you a facility by which to change that application relationship between a negative movement such as a sale and the positive movement that supplied the inventory for that negative movement. Now, why would you want to do that? There's a couple of scenarios. Maybe you posted an erroneous purchase invoice. You got the cost wrong on a certain purchase invoice with which you brought in some stock, and maybe you read the unit of measure wrong, and instead of posting 5 Rand a unit, you posted the equivalent of 50 Rand a unit, and now suddenly that purchase document and the cost amount actual on it is grossly overstated, and it just made your average cost completely wrong. But you only realize this sometime down the line, and a few sales already applied themselves against that wrong, that incorrect purchase cost, and therefore your cost of sale on your income statement for those sales entries are hugely overstated, and it's very negatively affecting your gross profit as reported on the income statement. Now, you're going to want to obviously correct that purchase invoice that was incorrectly posted, but you want to make sure that the sales that applied itself against that incorrect purchase is fixed. So what you do is you can go to the specific purchase that happened and say unapply anything that applied itself to this purchase. So you remove the application, and so what happens is temporarily your sales, they're floating in the air. They seem unapplied against any positive movement. You can then post a corrective purchase document, such as a credit memo, and you can force the credit memo, which is also a negative movement of inventory. You can force the credit memo to apply itself to the incorrect purchase positive movement, thereby eliminating the two to offset against each other. And then you can post a correct purchase invoice for the right amount, the right value, into the system, and then you can reapply the sales that you removed from the incorrect positive movement, reapply those to your new purchase movement that has the correct cost on it, and Business Central will then restate the cost of sale of those sales entries to reflect the applied cost of your new correct purchase entry. Now, the way in which you do that is by using a thing called the item application worksheet. And again, it's described here in an article that you can find at the bottom of this. It's in the links I'll send you. Remove and reapply item ledger entries. So this is how you do that with the item application worksheet. There's a whole article on it. But in essence, this is the item application worksheet. You can find the entry you want to work with by putting date filters in, or a specific item filter, or even a specific document or location filter. And then when you found the entry, again, you can do the unapplication and reapplication either from the sales side, the negative side, or from the positive side. Let's just choose that sample that I had earlier, this Paris chair again. Here's some purchases you can see. So if I go into this purchase here with 5 units and I say, show me the applied entries, there you'll see, okay, this purchase had applied against it this particular sale entry with a particular cost. And then from the screen, I can remove the application temporarily, making the sale float in the air, if you like, because it isn't applied to a specific purchase. And then when your other purchase exists here with some available stock, then you can reapply by looking for unapplied entries. You can reapply your sale entries against the correct entry. Again, for detail on how to do that, you can read this remove and reapply item ledger entries article, or we can do a more detailed session on that if anybody is interested. So that's the act of application and reapplication. Again, very useful, particularly to correct mistakes that have a negative impact on your, or erroneous impact on your cost of sales. The next topic I want to discuss is the valuation reports and the adjusting of costs. Again, the articles that I will reference for that is this reconcile of inventory costs with the general ledger. There's a whole article explaining how all that works. And then at the bottom here, it has a summary of the typical reports that Business Central offers that have to do with reconciling or reporting on the costs of inventory, i.e. valuation. And the main 4 reports there is the inventory valuation report, the inventory valuation work in progress report, the inventory valuation cost specification report, and the cost share breakdown report. Now, this cost share breakdown report is more of a manufacturing related report. So we would typically look at that in a manufacturing costing session. And so too, the inventory valuation work in progress report is related to manufacturing. So the 2 I want to focus on for this session is the inventory valuation report and its cousin, the inventory valuation cost specification report. Now, the main difference between these 2 is simply something we call expected cost. Expected cost is, if you choose to use expected cost in your system, it is what enables things like the ability to track goods received not invoiced value on your balance sheet. And it is also a way in which to post expected or estimated cost of sales to your income statement, even if the inventory that you sold hasn't been fully costed yet. What do I mean by that? What I mean is that when I post in the system a purchase order receipt, right, on a certain date and time, then if I use expected cost, Business Central will value the inventory that you just received there at the purchase cost of the purchase order, but it will regard that cost as expected. It's not the final cost yet, because the purchase invoice that you may only get a couple of weeks later or at the end of the month will determine the final cost of that inventory. So the inventory is on hand. Let's use this example again. The inventory will be on hand as a purchase receipt, but it won't have an actual cost. The cost will appear under a column called cost amount expected. I haven't enabled that column here, but I can, but I don't have sample data for that. But it regards the cost of that purchase as an expected cost. Now, let's say on the same day or a day or 2 later than you received that stock, which you haven't yet purchase invoiced, you process a sale and you sell those 2 or 3 or however many units. Business Central will regard the cost of sale of that sale as an expected cost, because it will apply the sale from an item application perspective to the purchase, because it has to offset positives and negatives against each other. But it understands that the positive against which it applied the negative sale, that positive isn't yet completely invoiced. It's an uninvoiced, it's an expected cost state. And so it must then admit that the sale and the cost of sale that applied against that purchase must also be in the expected state. And so if you look at your inventory account on the balance sheet, you have a sort of an interim cost on the balance sheet for the inventory, and you have another interim removal of that cost from the balance sheet for the sale. And when you look at the inventory valuation reports, you need to understand the difference between those costs that have been finalized and those costs that are still expected. And so that's why Business Central gives you these 2 inventory valuation reports. The one called the inventory valuation, the cost specification version, this one here, when you run this report, I'll just run it in the state it is now, you'll see that it gives a very detailed breakdown of what is direct cost and what is expected cost. There aren't any examples here, but you would see for a certain item a line for direct cost and a line for expected cost, and differentiate the quantities between those 2 and differentiate the value of completely costed inventory and expected costed inventory. If you don't want to see the detail broken down at such a level, and you want to see a more general reconciliation report between your inventory and your general ledger balance sheet accounts for inventory, then you just run the standard inventory valuation report. And here you can either include or exclude the expected costs. And it then gives you a more detailed list of all the inventory items with the filters you have, opening quantities and amounts, the increases in the period, the decreases in the period, and then a closing quantity and value, and then what has actually been posted to the GL, and those 2 ideally should match. And then if you add up all of these GL amounts here by inventory posting group, it should match the inventory control account for that inventory on your balance sheet. And that's the inventory valuation reports. Now, I mentioned here that if you look at the preview, ideally the closing balance of inventory here should match what has been posted to the GL. Your question should be, well, why would they differ? Why would I have inventory value that haven't yet posted to the GL? Well, the reason for that is because Business Central gives you the ability to batch post inventory to the GL. Let's just show you here in inventory setup. There is this setting here that says whether it should automatically post cost to the GL. If you switch this off, then you have to set up a job in the job queue to do this posting to the GL on a more batch basis. The reason you might want to do that is for performance purposes. In some companies that have a massive amount of items and they do manufacturing or very complex inventory transactions, it can have a performance improvement if you use the batch-based processing of inventory costing. And then so in that case, the inventory valuation report, having on the inventory valuation report a perspective of whether or not all of your inventory cost movements have in fact made it into the GL is useful, because then you have to just run that job. Maybe it has a bit of inventory movement to catch up. But in most cases, I would say in about 95% of implementations we do, this is switched on and it's real live, and so it's not necessary to do that. So you can you can safely use the inventory valuation report for that. And yes, that brings us to this final topic, which is what I just mentioned, which is the batch posting versus real-time posting of inventory in Business Central. And here you can see there's this article about reconciling inventory cost with the general ledger, what to look out for, what the concepts are, how to audit the differences if there are any differences, and the reports to run. And then if you decide to use the batch posting, then this is an article that describes how to set up the batch job so that the batch posting happens. And I'll send you all of these links again. Now, I'm amazed that we actually got through all of that with 5 minutes left. I don't see anybody having posted any questions. Marco, did you see anything that anybody wanted to ask yet?
I haven't seen anything yet, Ati.
We've got 5 or so minutes left. Does anybody want to put up their hand or post a question on the Q&A discussion board? Okay, with that, I'd like to thank you all for joining us today, and hope to see you at the next webinar.